Hello, everybody. This is Victor here from Trend Following Trading for Beginners, and here's my weekly update on my sample trading portfolio coming up next. Hi, everybody. Before the start of this podcast, I just want to say thank you for listening to my podcast so far. And remember, I'm here to help. If you have any particular query and you want to link up with me, you can basically contact me through Facebook messaging or Instagram or Twitter. And basically just ping me your question. I'm here to try to help you or at least point you in the right direction. So without further ado, here's this week's podcast. Welcome back, everybody. It's another weekly update. I don't know how you feel last week, but just to me anyway, it's another volatile week. The markets in the US or around the world go ups and down, and really quite scary in a way. I mean, on Monday, from the Friday before, it recovered. The stock market recovered a lot, and we have in the US there's like the highest I have never seen before. 1,294 points up, moving up, and because of the expectation of a rate cut, I suppose this is a snapback. We bounce, so to speak, because the U.S. stock market has been down far too long, far too much, or something. Well, not really long, it's only about 7 days or so, but just far too much in this very short space of time. And it just snapped back up, and then Tuesday, some funny things happened. There seems to have, I think, some telephone call or conferencing going on with the G7 countries. All the financial ministers were talking about how to what they need to do to match to calm the market, so to speak, because of this virus and all the scares around the world. See what they can do, and then we see probably Australia, I believe, and Malaysia cut the interest rate. But the European countries didn't say much, except just that they're going to accommodate. But in retrospect, you look at it, what can they do? They're already on a negative rate, and they already buy a lot of their own bonds back and stuff. They probably do more, but what else can they do? Even more negative, it's not going to help. Then the U.S. comes in suddenly with a emergency cut, and I think that's 50 basis points or half a percentage. Initially, the market really loves it, and your stock market basically gone up again, go very close to 200-day moving average, around 27,200 area on Tuesday. But then something happened. From the middle to the end of the sessions, the market in US gone down, and it's end of the day minus about 786 points. That's quite a telltale sign. It's like a reversal. Normally, from my point of view, I mean, you don't get emergency rate cut in US or anything around the world unless there's some major problem. So the Fed probably sees some problem ahead that the outsiders don't know about. So and then somehow the market is showing that, and then doesn't trust whatever US is saying, and basically do a about turn on the stock market in US and just going down. But the funny thing is, on Wednesday, the market again going back up again, another 1,000 pounds up, 1,173, but the Treasury 10 years bond, US Treasury bond, have gone to like close to the 1% mark, 1.02 I think. And then Thursday, Dow Jones gone down by 969 points, so almost 1,000 points. The Treasury yield gone below 1% for the first time, and Friday was gone down, I think, about 700, 800 odd points at one point, and then it recovers a bit, but it's still down like 256 points. And the Treasury bill bonds in US, the 10 years one, is down to like 0.77 or something very, very low. And just as of yesterday, I read from the BBC News, Lebanon couldn't meet its bond interest payment, and it's likely to default its payment. I think it's due on Monday. Just couldn't pay because of this economic downturn around the world, plus the virus going around. and they have its own problem as well. So there's another major country coming up with default coming on Monday. When you step back, for me anyway, this couple of weeks very much like, I know it's like a deja vu thing, because I remember back in 2007, 2008, I was a contractor then in Bulgaria and watching the financial news with my friends, my work colleague, and then basically just see that the market goes up 800 points, boom, suddenly gone back down 700 points, and you keep on hearing Europe and around the world, America, keep on pumping more money into the financial systems, and also the what you call the forex basically just go up and down, gold slowly moving up as well. Those kind of things. And for sort of past 2 weeks, to me basically it's more like a deja vu. What I see in 2000, it just come back to my mind and it happens. And the main thing that we prompted is this emergency cut. Normally nobody do a cut. The last time it was Lehman's brother went bust and Bear Stearns got taken over by somebody else and all sorts of stuff. But it was only after, I believe that was only happened after the emergency rate cut by the Fed. I think last time, even larger, the last time was 75 basis points, so 0.75% rate cut. And that was quite, I've never seen before. But this time, okay, the rate cut is lower, it's, still 0.5%, it's quite a lot in my view. But the thing is the volatility. I mean, last 10, 12 years ago, the volatility is plus minus 800 range. Now you see the volatility of 1,000 points up and down. And last time it's only do suddenly there's this last job and then a quick rebound the next day. It only happens spread around a couple of months kind of thing. Now it's like within the space of 2 weeks, we have thousands of points going up and down very quickly. I mean, to my view, I already said last week or so that there's most likely because of the panic causes a lot of forced selling out there in the market. And basically people just got scared and prompt and then got cold feet and went into a treasury bond. And this time there's just so much, I suppose, free money running around. There's just, everybody in stocks going into U.S. treasury bond market. And then you try the 10 years yield down to, below 1%, which was never heard of. Even back in 2008, I think it was just above 1% or something. It never went below it. So I don't know what's going on this time. It's just so scary. I mean, generally, this is how I think. I remember it. Interest rate go up when the market goes up. Because, come to think of it, if the economy in any country is doing well, it just, go and buy more external stuff from other countries and stuff. So there's inflation. And so the country's central bank probably just increase the interest rate, so just like cool down the market a bit, economics a bit. So it's nice and steady up. So as the market continue to move up, the interest rate continue to go up. That kind of thing, just so that give the market a more even keel kind of expansion rather than let them just go, jump and get the inflation go skyrocketing. So that is a general view. And then when there's problem in the market, the central bank will just basically come in and doing rate cuts and then slowly cut until the markets settle down, or in the case of US, there's no more you can cut or something. And I mean, look at Europe. What can they do? Look at Japan. It's been cutting interest rate to near zero and pumping lots of money in it. There's like lost 30 years, it's not lost decade, they've been down since 80s or 90s, in the downturn in the stock market in Japan. And they continue to put more money in, it's not helping them either. And Europe is repeating the footstep, and US looks like repeating the footstep. So all this is just not good at all. And then you look at the talking heads in the financial news, they say, oh, now it's only a correction because it's down to 12% or something. It's not a bear market yet. You should go in and buy some more. I sort of remember that similar case was argued on some financial news, like Fox or something. I was watching back in 2008, and what happened? You know, we all know the market tanked. And if you have read or watched the film called Broke by Michael Covel, I think it's online somewhere, or you can buy or rent it. And it's clearly state how the whole things went in 2007, 2008, especially the bit that talks about how the financial news anchor woman and man is saying things and then refuse to give him an interview to ask, how can the financial news keep on telling people to buy when the market is tanking? That sort of stuff. And it's worthwhile to just go and watch that to refresh and remind yourself what happened. It's very similar things actually happening this time. But I think the bigger concern this time round, to me anyway, it's not a stock market. It's really the bond market, because there's too much money going around. The U.S. has been pumping loads of money around the world. This time around, it's not just U.S. It's been around the world. Japan used to do it a long time, then followed by U.S. And because of the last financial problem, Europe is doing that too. China, last time they was not as much in debt. Now they print a lot of paper as well. A lot of debts coming through. Excuse me. And but it's still the what you call the creditor, the largest creditor of U.S. bonds in the world. But because of its own virus problem, and also I think the last 6 months or a year already, people have been saying, in Hong Kong and China, that the Chinese government is slowly selling government bonds very quietly. It's not been buying vigorously as before, and I believe probably they will sell a lot more this time, probably in your face a bit more, because they have basically the virus problem. The whole country for the last 3 months is more or less in a shutdown mode. You're not producing anything. Now it's sort of like start to come back up again. But all this, ramp up takes time. So I would say the first 6 months of this year, it more or less producing very little in China as a form of output. So they cannot hardly ship anything out to other countries. But they got people there. They need to eat. They consume things. So what they going to do, either print more money or sell whatever treasury bonds they have from other countries. In this case, I think they're the biggest holder of U.S. treasury bonds. So they will start to sell. So most likely a combination of printing more money, more fiscal stimulants, more projects within China, as well as, to pay for it, selling down some of these U.S. bonds. And then because of this scare, I think they're actually using this, the virus scares, to sell more bonds quietly when everybody's concentrating on the virus side, how they spread around the world. They're just selling more bonds because they need the money. They need to buy food and stuff. And then because of the scare, other investors from around the world, in the Western world, basically just snap up the treasury bond. And I think that's what's happening at the moment. But the other problem I see, I think I said the last couple of podcasts as well, the bond market, it's not just U.S. Fed, asking for more money and people keep buying them. All these IOUs are actually coming out from a lot of, companies. Good companies as well as, some companies not making too much money. What I'm worried about is the slowdown of the economy in general. Even the strongest one might face pressure paying the interest on the bonds. Apple's, Amazon's, okay, fair enough, they got a lot of money in the background kind of thing. But what about other companies? And all those smaller companies as well, they're not making new sales with the virus coming around. A lot of things got stuck. And I don't know how they survive. It's likely you see it, instead of just a stock market blow up, you see a lot more bond market blow up as well. I think that similar things happened back in 2008 as well. But I think it's a much bigger bubble this time. And I don't know how it goes. With the 10 years U.S. Treasury bill gone below 1%, what does that mean? We've never been there before, not in my lifetime. So I don't know what might happen next. but just from my own analysis, from the U.S. Dow Jones, I see it tried to make some sort of double bottom or something for a short term. I mean, the first time when it go down really big on the Dow Jones, it gone down to as low as 24861, and then I think that was done the Friday before, and then it have a sudden snapback and only down at 200 points. And last Friday, the Friday just passed, and it gone down to 25226, and the market gone down like 700-800 points at one time, and then it snapped back up again, and it's down by 256 points. It's most likely the short term traders, covering the short and in the weekend want to carry it over, and that's why the quick snap back. So I don't know what happened next week, but it looks like from just the Dow Jones, just having a look from the chart point of view, it is making two bottoms, and one leg is higher than the other one. So I won't be surprised for me to see next couple of weeks or so we have a bit of a sideways move, or even a bit up, further up, back up to the 27,000 mark. And then I think mid of March, around 18th of March, there's another US Fed's decision meeting, and it's likely, the market, I think the bond market is basically telling us it's likely the Fed's going to cut another 0.5 percentage point, minimum probably 0.25 percentage, and we'll see how it goes. But I think a lot of people already said this, or I'm just repeating what they said. The Fed, the cutting interest rate is not going to help people's view, is it? It can help the market a bit, the economy a bit, but it doesn't calm down people's fear. Remember what I said before, the virus has been around, this Chinese coronavirus has been around, reported publicly back in mid-December. And most of the Western world think it's very much of a Chinese problem or Southeast Asian problem, because it spread to Japan and South Korea. Now, when it hit the doorstep in Europe, people suddenly start panicking in the Western world. And, this is a type of thing. I think the market in general just going bananas, in my view. Initially ignoring the virus, say, it's only supply chain, it's only China, it's only South Korea over there, poof, we don't have to worry about that. Suddenly, when it comes to, Europe, such a big problem now. Everybody just goes so scared and gone right the other way around. And what about, there's not enough test kit or medical equipment or clothing, so those kind of stuff, which mostly, a lot of them, the cheap one is manufactured in Southeast Asia, especially in China. And then now they only talk about, what we can do, what we should do, how we can, control the spread when the virus is just spread for so much. I think it's either airborne or, people have been carrying it, have been traveling around before the shutdown in China. And because a lot of them are carrying very mild cases, very much similar to a general flu or cold, people has been spreading probably for months before the Chinese lockdown. So that's why it sort of blow up now a bit more. Other countries are seeing it, slowly seeing it. And I don't know. I just personally feel this this market is going to is tanking, and I'm not going to have much hope for this year, for 2020. You can kiss goodbye to 2019. Up 20-30% kind of thing. It'd be a good omen even if we just break even. No gain this year. But I think the markets just go down and down from here on, for at least for this year, maybe into next year as well. So people say there's a stock market should go up, or at least go sideways, stable during a U.S. president's election year. But that's the past. Every year is slightly different. This year maybe same as last time when President Trump got elected, and Obama handed over to Trump. The market was tanking at the time, but that was change of guard, change of different, from Democrat to Republican kind of thing. But then this time, it's just continuation of a sitting president. it shouldn't have a stock market going down in the U.S. That's what the belief is. But who say never, never, never? Things can happen. The market can just do its things, and it's likely the market's going to come down this year. That's just my point of view. But from a trend following point of view, I don't care. I see the market going down, I jump on it. But like I said in quite a few of my podcasts, I've gone through the hoops of developing myself and stuff. Those what's it called? Those technical analysis kind of way thinking is still in me. That's why I have a separate account. That's why I have my own trend following system account as well as other separate account just to so if I have a hunch or something kind of thing, I separate and give it that in the separate account, so it's not affecting my trend following account. But when I put my trend following hat on, which is my core, I believe in trend following very much, so just very systematic approach, just suit my personality. I just think, well, the market's tanking, it's going down. I know I got hurt, last week, which I said in my last podcast, when the market just do a sudden about turn, and I just follow the rules. The rules say go down, even though I don't believe it. I thought, wow, suddenly 1,000 pound down. You think continue to go down? What's my system telling me? Well, the system said go down. It's going down. Short the market. Okay, I short the market. And now we see it. The shorting on the market was good. So it covered quite a bit of my losses. In fact, make some money. So which is good. But these are the type of things that trend following system will do. Or trend follower will do. If the system say go down, even though the system signal looks ridiculous at the time, you just continue. And this is what I'm gonna do. So basically, from my own point of view, basically, I think this virus thing has sort of been overdone a bit. I mean, you see how human beings' emotions go into the market, extreme, high and extreme low, and don't have think even keel, don't step back and think of what is actually happening. So the efficiency market theory in economics think everybody is rational. That's out the window for me. Any person is out the window a long time ago. But I'm just wondering why the education system still teach about it. Just a bit waste of time to me. I mean, it's better to go talk about economic finance kind of thing. How humans interact during greed, high time and bad time. How people react in the economy. How they do things in the stock market. That's more interesting. But basically, I mean, I look at this market. There's a couple of things I want to share with you that why I think is a bear market, because these are my sign. These are my little indicators that I use from my own development. When I go through my journey of being a trader, I'm still developing myself. But these are the kind of things I've seen. Back in 2008 more recently, and then 2003 and before 2000. And you look at it, you see, first of all, there's when this market about do about turn around, you see volatile market move up and down. We've seen that recently. This time 1,000 pound up, 1,000 pound down. You've seen that because the market's got spooked about something by some economics or some, in this case, virus or something else, or the Russia used to the ruble default back in the 80s or something as well. Those kind of things that happened. So the market just moved up and down. Then because of the market problems, the government have the government around the world have got some financial information and basically pumping a lot of money into the market, which is actually happening in the market and around the world as well. And then they also come in with some sudden emergency cuts, and that sort of hold the market a little bit. But then there's more cuts coming down. Not emergency, but subsequent meetings of the financial authorities. Just continue to cut rates. Excuse me. Then obviously this scare the people, especially those pension funds and people like those, and go into U.S. Treasury bonds. And to me anyway, this is just my own system, which I talk about in the update. My long-term system, the price of whatever share price index you're looking at is gone, mini index, gone below the 50 days, 20-day moving average. and the share price follow through. And those are for me this is sign of a bear market. It could be a correction, I don't know, but every time it's large correction or bear market, this type of thing just shows up, and then you see a large move of gold going up, and silver is always lacking. Now at the moment, silver is not moving up much, and gold has already gone to near 1700 for only $200 or so towards the all-time high 1900 back in 2012, or I think, or 2011. So this is the type of things I sort of see. Also the other thing is the talking heads in the financial news keep on saying, "Oh, it is just a correction, and do you believe it's going to be a bear market?" They keep on telling you to buy and hold. Now is the best time to buy the strong market. Strong company who can sustain this down period. Don't get out. But then what happened back in 2008? Most shares tanked. Not just 10, 20%, 30, 50, 70%. What are you going to do? Sitting down, listen to the financial talking head, they just say, "Oh, it cannot go down anymore." Just debate, in front of TV and audience. Can you actually make financial decision based on those people talking? You can't. That's another thing that sort of indicated to me. And of course, the world economy is not doing well, so we got recession and so forth. So the crude oil goes down. That's quite other thing. And also, while the market is tanking, people get scared as they go into the U.S. bond market or bond market in general. The basically the U.S. dollar index going up, which we also see as well. So all these little indicator, just my point of view. The U.S. market is in a bear market, unless it can break back above the 50 days 200-day moving average. On a sustained level, not just a day or two, but actually for weeks. And then, I'm not buying this. It's a correction. Personally, I think it's a bear market, and I basically act accordingly. So the other things that I said it before previously as well. People should to learn about how to short the market. It might be in your country you're not allowed to do so, but there's something called options. You can, buy a put option. Basically, you give up amount of money to say you have the right to sell share price or index at a certain level. And basically, when the market's gone down, you make money that way. Options is available, I think, in most country. Even in US, if they're not allowed CFDs or spread betting, those kind of things, options is available. Try to learn that. So don't. My message: don't be a sitting duck when the market gone down. You can make money when the market gone down. It's up to you to learn how. Trend following showing you one way. Why you buy and hold during the down market? You can't. You hold. What happens if you got Enron? It gone down by $60, $100, whatever, to pennies. It gone out of business. What happened to your pension funds? What happened to your retirement? Nobody cares more than you about your money, about your own retirement. You think the government's gonna look after you? Please don't. If you think that way, then I think forget about looking after your own future or doing trading to try to give yourself some edge so you can retire a bit more comfortably. And the government is not there to look after you. That's as far as I'm concerned. And that's when the stock market going down. Remember what the U.S. saying: when the bear goes up, it walk up the stairs. When the bulls goes up. When the bulls goes up, it walk up the stairs. When the bears happens, it jump out the window. As case in point, last couple of weeks, the price of stock market index around the world just plummeted, especially U.S. And that is what's happening. So this is basically how I see it. I mean, China at the moment is recovering, and I think from Foxconn, from Taiwan, they're saying people in China, the factory in China is already have up to 80% people capacity. Going in, people are going back into work. The output is up to 80% capacity, that kind of thing. So it's slowly coming out there, but it takes time for the market to come back to its full gear like before. But I believe if you look at it longer term, the Asian country will recover first, and the U.S. market or the Western world will recover next after that. But I think the damage, a lot of this fear is overdone. But that's just human beings, and we can all benefit from it because we're traders. And remember, don't stick or love a share or index or forex or whatever and marry to it, never get out. Okay, when it's really bad, the market's there's about turn your system, say get out, then get out. Don't marry your position. That's what I try to say. So without further ado, next will be my update on my weekly portfolio update and see how it goes. Okay, first off the bat is Apple. Short term is turned to a buy now. This short term bounce, but long term, medium term is neutral. Amazon short term is still sell same as last week. Long term, medium term is neutral. USD, Australian dollar against USD. Short term is a buy now, and medium and long term is still a sell. Crude oil, Brent crude, and US crude WTI, they are both short term sell, long term sell, medium term sell. It's not a surprise, especially I think on Friday, the OPEC tried to get Russia to agree to a price cut, or something not price, cut the output of the oil, crude oil, but they didn't agree, and I think it gone down like $4 or something, like that's like 10% these days, and it's a lot, but I think a bit overdone. However, my system basically say, well, just for a market, who cares? So okay, fine, sell, continue to sell. So I hope you cover on those. Next is DAX, same as crude oil basically. Long term, medium, and short term is a sell. Dow Jones short term is still a buy. Just we got the bounce on Monday, and basically the week last week, the Dow Jones I think is still positive, just over positive, so still a buy short term. But long term, medium term is still a sell. FTSE, same as DAX, basically sell across the board. So all the European indexes tracking here, the two indices is going down. I believe France is in a similar position, but I'm not tracking here. Gold, short term is now a buy, long term, medium term is also a buy, so full steam ahead. I think one thing worth noting on gold is last time when the gold went up to I think 1691 something area, and it's doing similar thing on Friday, I think, last Friday. And it went up to 1689 or something, very close to 1691 area, and then it did a bow turn, went down to $50 something, and then stabilized back to 1670 area. So fluctuating a lot. So if Dow Jones or U.S. market stabilize a bit, or around the world stabilize a bit, you can probably see the gold coming back down again. But I'm not getting my hopes up. I just go let the market tell me what to do. So as far as my trend following system tells me, it's still good to go. It's buy across the board. Hang Seng, the Hong Kong index, sell short term, medium term is neutral, long term is still a sell. Nasdaq, sell short term still, medium and long term is neutral. Nikkei, is same as Dow Jones. Basically, same as DAX. Basically sell across the board. Short term, medium term, long term is still a sell. Silver, short term is buy, but medium and long term still neutral. So it's not doing much. Apart short term is following what gold does. Silver, basically long medium term, the trend still sort of neutral, not doing much, around the 1750 area. USD again, the Chinese yuan, short term is a sell, medium term is neutral, long term is still a sell. USD again, Japanese yen is a sell across the board, short, medium, long term. We've seen the basically, I think that's what I would say, wasn't it? When the US market is tanking, people who borrow money cheaply from very low interest rate country used to be, back in 2008, used to be just Japan, but now it's also in Europe as well. So basically, when the stock market in US is tanking, people just basically go and buy Japanese yen as well as European dollar, euro, to basically return the money back to source, so to speak, and just wait and see. naturally return it back or not to where the lender is, I don't know. But it's definitely changing back to its own original currency, and which is driving up the yen as well as the euro. The yen is not helping either. Every, I think in March, I think that's year end, and they bring a lot of the money from outside Japan back to Japan for the year-end calculation for a lot of the companies, and that also significantly drive a driving force of Japanese yen going higher. So basically a perfect storm. Personally, I think 105 for my analysis is about right, about the bottom, but it can go a bit further because just human emotion driving the market at the moment. It can go even gone below the 105 to the US dollar area. Well, time will tell. Next, British pounds against Japanese yen, because of the Japanese yen gone down. So similar to USD against Japanese yen, short term, medium term, and long term is the sell for British pound against Japanese yen. But for the British pound against the US dollar, slowly it's following what the euro is doing. So short term is a buy, medium term is neutral, long term is a buy. So a bit of a two halves. The British pound against Japanese yen is still tanking. The British pound against USD is coming up. So we'll just have to wait and see. Bitcoin, basically still sell. Short term, medium, and long term still neutral. There's a lot of talks that saying out there Bitcoin is still holding up. Still going to see a bull market coming up. I don't know. My analysis basically telling me short term is a sell, medium, long term is neutral at the moment. We just have to wait and see. The bit I introduced last week, LTL, the ETF which tracked the Treasury high end Treasury bond. I think it's 20 plus years one. Basically, it's buy just like last week. Basically, on Friday as well, it gone up significantly because the U.S. Treasury 10-year yield bonds gone down. So when the yield goes down in U.S. Treasury bonds, the actual prices has gone up. So in this case, it's helping this LTL ETF, and the price just going up and up and up. So we just wait and see. So I use this as a barometer, basically just check how crazy it is with the bond market, and also I'm trading on that one. So because I don't generally trade a bond, but I think these ETFs will help me, and I found it, and I'm going to go in at the moment. It's like last week I started tracking it and buying it, and it's buy, so which is good. We just have to wait and see. Basically, that's the end of my podcast for this time. So in the volatile market, I just hope everybody keep their hats on, follow the systems, don't marry the position, and don't lose faith. The market's just going to do its things. And in this instance, reduce your trading size, and so you keep, basically keep the same risk. Okay, don't increase your risk by giving it your position a bit more breathing room. You can do that by reducing your trading size. Okay, instead of buying 10 lots or 10 shares, whatever it is, buy one. Just tracking it. You buy 1,000, just buy 100. Give yourself breathing room. Keep the same risk, because at the end of the day, we trade every risk to be normalized, okay? Because we don't know which of the trade will make you lose some money, or which one will lose you tons of money. And basically, if you keep the risk the same, you will come up good at the end of the day. As I said previously, a lot of my podcasts I never seen, personally, I haven't seen consecutive 20 losses in a row. I've seen 7 or 8. Some other people I read about have 10, 15. We just have to wait and see all this fluctuation market going up and down. But when it happens, it hurts. I know it hurts emotionally, and you want to make your money back quickly. But the other thing also instill in you is, if you say you lost market in Apple or not money in Apple, it doesn't have to make your money back in Apple. You can make it back in bond or Forex or some other shares. Okay, these things have to get even back, get your money back from the stock market from the same share or same instrument you use. Don't do that. There's other bull market here that's in LTL, tracking the U.S. bond is making loads of money here, and it's going up. Why don't you redeploy your money the other way around? All this buy and holder. Sorry, I'm not in that camp. I don't believe in that. I believe in what the market does. It always just do its things. Sometimes you agree with it, sometimes you not. I'm just a trader. I'm trying to make money. So remember this, especially when the volatile time when you're not making money. Stay strong, continue, keep on plowing, don't give up your system. All your tests should have been done before you actually go in the market. You haven't done that, get out of the market, keep your money dry, keep powder dry, so to speak, and go back and retest your system. Just make sure. I mean, don't try to be in a hurry trying to make money. The market will still be there tomorrow unless we got hit. I mean, Earth get hit by a big major meteorite, and then we all buggered. We all die. Money in that sense is nothing. You just try to survive. So unless that happens, I say the market will still be there tomorrow, and you should be more rational. The market is not rational, and you should be. I mean, this come to my mind is what Warren Buffett said: when the market is fearful, we should be greedy. When the market is greedy, we should be fearful. I take this as when the market is doing its things, going to extreme, you need to keep an even keel, even thinking. Okay, think of an analysis how it goes and stick with your system. As a trend follower, I also look into fundamental as well. But I believe, and this is in bottom of my heart, trend following, systematic trading is the best way to beat the market to make money. You can marry it plus a bit of fundamental or whatever your flair is, but everything comes down to maths, comes down to the basics bond. Can you trust those maths? Can you trust those systems? If you are new to trend following, learn trusting your system by you can use what you call demo account. But demo account, I've said it before, I've said it again here, because if you don't have real money actually on the market, actually losing money, and your emotion won't kick in a demo account, it's only half a bucket. You want to learn the other bit. That's when you're losing money. While you're actually losing money, you learn tons about yourself. But you don't have to spend loads of money learning it. Buy one share of Apple, just tracking it for a year and see how it goes. Okay, you think that's simple? Okay, try to buy 10. Still think simple? Go to 100. Give yourself every year just to do that. And slowly and surely you found yourself what you can tolerate, what you cannot tolerate. And hopefully during that time you see some bear market as well as good market. Then you see what you're making of, and do you actually trust your systems and do things with it. There's no free lunch out there. Don't believe all those courses out there say, hey, buy this course and you become a millionaire in no time, like me driving a Lamborghini. Well, excuse me, they forgot to tell you it took them 10, 20 years. Look at Warren Buffett, compounding increased 29-30%, but that took him like 30 years. I mean, a lot of people into Instagram, social media nowadays, YouTubers, you see them, making money. Hey, look how much I make, blah, blah, blah. No, they make through a lot of hard work, those actual ones, those good ones, and they just, they have to actually show you how much hard work they've done, especially when they are down big time and they still stick with the system and come back up again. And I think Tim Skype is one of the things person I look at. He personally trained quite a few people, and I look at his YouTube videos, and what does, some of his students are fantastic. But remember how long it took those students? I think one of the highest, the best one he got is started from just under $2,000, and now it's like I've got 10 million profit or something. But that took him like 10 years. It took him a decade to do that with a mentor, checking him out, helping him, encouraging him. We, as nobody, trying to learn ourselves, try to beat the market on our own. There's chance. There's always chance, but it just takes time. You can learn, just like you can learn to swim, but you want to become an Olympian? Sorry, become a top 1%, you need coach, you need direction, you need constant hard work. I've seen my children doing competition gymnastics. That top 5%, you can reach it, with hard work, with some guidance. But you want to go top 1%, you really need loads of guidance, really about soul searching, and work hard, work like a dog. So I hope this podcast is helpful to you, and I will speak to you next week. Bye for now. Ciao, ciao.